Bet you didn't think this would be the year you achieve the dream of flight. iFly Indoor Skydiving lets you experience the freedom and thrill of flying. No experience or wings required. iFly is fun for people of all ages and abilities, and it's the perfect choice for a night out with friends, family birthday parties, corporate events, or even just celebrating a Thursday. You'll never forget your first time flying. Go to iFlyWorld.com and use code TAKEFLIGHT for 20% off. That's iFlyWorld.com, code TAKEFLIGHT.
This is Scott Becker with the Becker Private Equity and Business Podcast. We're joined today by Matt Wolf, who's a senior leader at RSM. RSM is the leader in middle market private equity. Matt is just a brilliant and thoughtful leader. He talks to us regularly about trends in private equity, trends in business, trends in healthcare, and a lot more. Matt, take it away. Tell us, what are the big things you're watching quite right now in the private equity market? It seems like all of a sudden it is busier than heck again. It's turning over quicker than the New York Jets roster. What is going on with private equity, and what are you seeing?
I love it. Yeah, absolutely. I mean, anecdotally, right, we're very busy. Clients looking at new deals or looking to achieve some sort of liquidity event. Things, the September rate cut really propelled a lot of activity, as you and I had predicted, and as many others had predicted as well. Kind of unsurprising. One thing we've been doing recently, now that it's October, has been looking through some of our data sets, Bloomberg, PitchBook, Cap IQ, some others, around trying to get a sense of where is the actual deal volume, where is it going, what is the size of it. And it's interesting. For the past few quarters, of the first 3 quarters really of 2024 have been very solid in terms of deal volume, right around 1,500 deals per quarter. Yep. And then in the last quarter that ended, September 30, we saw a huge increase in the value of deals, the dollars putting to work in those deals. So we went from 100 billion in the second quarter to almost $200 billion of private equity capital deployed in Q3. And we're on track to beat that, certainly on the deal. I expect that we'll beat that in the deal count and likely in the capital invested side as well. 200 billion is a pretty significant quarter, even pre-pandemic, tighter monetary conditions. So anecdotally, we're seeing a huge increase in deal flow, deal volume, and we're beginning to see that in the data as well.
Fantastic. And are we seeing that? I mean, the huge funds sort of got in front of this, but you're seeing it now at the mid-sized funds too, aren't you? I mean, I hear at the middle market practices that all of a sudden things are quite busy again. Is that consistent with what you're seeing and hearing?
Yeah, absolutely. And so, the on the deal count basis right now, if you were just to annualize the sort of, and this is why we look at total deal count, why we think it's important, is because it does capture, all those small tuck-ins or the smaller middle market platform deals that, BlackRock, Apollo, some of these other big shops don't typically touch. And right now we're on track for 1,500 again this quarter. I really expect that we're going to exceed that pretty substantially, and it's going to be driven by a lot of the smaller and sort of maybe core mid-market activity. And so then the real question, I think, in terms of just the overall deal volume and the deal capital that's deployed is those bigger mega funds. Are we going to see another round of take private transactions in the fall and the winter? I think we will. So we'll likely pass that 100 billion, maybe get closer to 200 billion again this quarter. But absolutely, small middle market deals are very hot. I guess the big unknown, though, as we sort of swing back into deal making mode, is what does the diligence look like on that, right? Back in the zero interest rate environment, we had clients who do diligence on smaller deals, some level of diligence, very light maybe. And lately we've seen heightened diligence on these deals. And I think the $1 trillion question really is, to what extent are diligence measures going to fall with interest rates, right? Or even as interest rates come down, are we still going to see kind of extended diligence periods even on sort of the smaller and more core middle market areas of the business? I think they'll come down somewhat, but I wouldn't be surprised if sponsors continue to exert more sort of diligence over these smaller deals than they might have, a few years ago, even as interest rates come down.
Let me ask you a question around that, and I'll do one of the most obnoxious things that someone could do that's been in this for 30 plus years. So bear with me for a second, and I'll try this out and see how obnoxious this sounds, Matt. So if you've been around doing this for 30 plus years, you've seen recessions, you've seen ups and downs, you've seen periods of time where every deal seems to go south. You've seen softness in deals. I remember periods of time in our healthcare private equity conference where half the people there, maybe not half, seemed like they weren't looking for deals, they were looking for jobs. Now, this is the obnoxiousness of this. If you've been in this for 30 years, you've seen a lot of ups and these downs, and you hadn't gone through that many periods where due diligence shrank to nothing because it was such a seller's market like you saw several years ago. One year during COVID where it was incredibly hot, one year before tax change was supposed to take effect where it was just so hot, people just want to get deals done at any price. Then you saw for the first time in many of the younger people's careers, and this is part of the all part of the obnoxious rant of the older person saying, well, I bet younger people haven't seen this. Then you saw for the first time a lot of the younger people being exposed, younger private equity professionals being exposed to real challenges in the market. To all of a sudden, no money being put to work for a couple of years. And how much will that be a great experience for investors, or how much might that make some of them gun shy? Are they just going to be so excited to put money back to work now that they'll forget that things could go south? Because this is the first time I hear people every day talk about, we did this platform deal, we did this bolt-on deal. The bolt-on deal is a disaster because margin shrunk and interest rates went up. And so it left people a lot more cautious or a lot more thoughtful. It's your points on diligence. Yeah, how much there are you going to see like those lessons, or those lessons all fall away very quickly as people get excited, put money back to work again? What's your sense of that?
A lot of people are going to get burned as the economy normalizes, and I think we're going to see sponsors, operators, deal partners get overzealous as the monetary policy eases and will fall back towards this comfortable experience, as you're sort of alluding to, of the near zero interest rates, of more limited diligence. It's, you just bolt some companies together and make money. That's not going to work going forward, but I worry that when it comes time to do the deal or not do the deal, we're going to see sponsors, investors err on the side of doing the deal as interest rates come down, sort of perhaps subconsciously assuming that, okay, well, we're going back to the prior regime. Interest rates are falling, they're going to go back to zero. We can do these same kinds of deals again that we did, in 2021, 2022. And that simply won't be the case. It might work out by coincidence, but part of sort of normalizing the economy into this new macroeconomic regime is that, yes, it's to your point, right? It's something that we had this sort of rate environment, 30 years ago, and where we had to really focus on actually building a business and making investments in a business, and monetary policy was less important. But we have this muscle memory of the past 15 years that I worry is going to burn a lot of folks. And really at a high level, this is just what a normalizing economy looks like, right? If we go back through the economic cycles of the last 100 years, this is almost you might say a feature, not a bug, but it's just something that happens as part of this sort of economic normalization. And sponsors, management teams, everybody, advisors are going to have to be really, really cautious and really cognizant of our sort of muscle memory biases, and remind ourselves that yes, interest rates are getting lower, money is flowing again, the deal environment is easing and it's becoming easier to do deals. That does not mean it's going to be like it was prior to this interest rate hike.
And let me ask you another question. And I know that you're not permitted to talk personal opinions in this at all, but do the RSM economists have a perspective on whether a Trump presidency or Harris presidency has a different impact on the private equity markets, or is there not really a perspective out of RSM on that? How do
Yeah,
they
we
start to
don't.
thought lead on those things?
Yeah, I mean, we don't have an official perspective, and I would say my perspective, again, for what it's worth, and I'm going to be a little careful here, but is that, essentially there's so much unknown right now. Even if we knew today who would be sworn in, we still don't necessarily know the makeup of Congress. We don't know all the politics involved in getting policies changed and what all that means. And what one candidate says on the campaign trail doesn't necessarily, or rarely, I would almost say, translates into policy. I will say though, and this is undeniably true, is that the uncertainty around the future administration, that creates a tax on decision making, right? We don't know. We can't really game out what that's going to look like. There's just way too much uncertainty, and that creates a tax on making business decisions. That lengthens the deal making process, all else equal. It makes it more complicated. So we'll get some level of clarity one way or another here in about a month, hopefully. And that, whether it's one candidate or the other, that should at least lower the level of uncertainty, which should help sponsors, management teams, everybody make business decisions, right? As that uncertainty level comes down.
But your point is so well taken. There's always I don't there's always this uncertainty tax. The more uncertain things are, the more cautious people are about deals, the more cautious lenders become, the more cautious everybody becomes. And I think that uncertainty itself has a very real impact. I think that's a great
Absolutely.
point.
Yeah,
Matt, anything else that's top of mind for you currently that you folks are front and center on?
yeah, I think it's the only other final thing I'll say is that it's just been really fascinating and interesting to see how different sponsors have taken different approaches to this changing environment in terms of strategies around maybe expanding operate, maybe their strategies to expand operating partners and how many they have, and trying to really cultivate a deep bench of experienced industry executives to help drive value, or really getting innovative in how some of these deals are structured to try to even better align financial incentives between buyers, sellers, and management teams. Or maybe they're taking an approach of making strong investments in technology and infrastructure that supports their investments, even if it's a $25 million revenue company, right? These strategies exist across almost all levels of deal making. And what's fascinating is they've almost like sprung up like mushrooms overnight, right? All this differentiation in strategies. And in the prior environment, right, private equity firms, they always kind of had a little bit of a different flavor of a strategy, and that's how they would go to market with their LPs and go to get deals done. But we have just seen such an increase in the diversity of these strategies and the way that the sponsors are trying to at the end of the day, they're selling money, right? And that their strategies, how they're going to market to sell their money. And it's just been fascinating to watch. And I think it'll be really fascinating to see how, which of these strategies are successful in which situations, in which industries, at which deal sizes. There's going to be a lot of interesting textbooks and academic papers and shareholder letters written or LP letters written as a result of this kind of diversification of private equity strategy.
We could not agree more, Matt. And again, Matt Wolf from RSM, one of the brightest minds in the private equity business. Matt, so great to visit with you again. Thank you for joining us today on the Becker Private Equity and Business Podcast. Thank you very, very much.
Thank you, Scott.